Okay, good morning, everybody. We're going to talk about the American Opportunity Credit first. It starts on page 6-6, right at the bottom. It helps provide, as you can see, tax relief for higher education. That includes bachelor's degrees, associate's degrees, and also vocational training, welding and such like that. It includes tuition, fees, books, course materials, things like that. It does not include room and board, transportation, those other things, personal living expenses. It consists of 100% of the first $2,000, and there you go, 100% of the first $2,000 right there of expenses. And back one more time. And then 25%, or up to 25% of the next $2,000. So the maximum credit is $2,500. If you look on page 6-9, you'll see that the phase out, there's a phase out range. So it phases out for married filing joint returns between $160,000 and $180,000 and $80,000 to $90,000 for single or head of household filers. I don't believe you can get this credit for married filing separately. Look on page 6-9, if you will. You can see how an example is of Jenny, graduates from high school. She goes to Big State University. She takes 12 or more credit hours to be full-time. And this one, you have to be at least half-time during the term, during one term during the tax year. Jenny's father pays her tuition and fees of $2,300, and so he can get that on his tax return. You can get this for yourself, your dependents, or a dependent student. It could be your spouse or children, other dependents. And so he gets of the $2,300, he gets the first $2,000, and then 25% of the next $300, which is $75. So his opportunity credit is $2,075. Look at Jason. He's single, AGI of $85,000. He pays $5,000 in qualified tuition for his son, who's at Party On University, where many of you will want to go, I'm sure. Anyway, he would be entitled for a maximum of $2,500, 100% of the first $2,000, and then 25% of the next $2,000. However, we have to recognize that he is $15,000. See, yeah, he is $5,000 into the phase out range. So you take the top of the phase out range, 90,000, subtract his AGI of 85, divide it by the width of the phase out range. You're used to that calculation from other things. So 90,000 minus 85,000, divide that by 10. So he reduces the credit by that amount, which is $1,250. Reduces it by half. Let's stop right there for just a second, and I want you to turn the page to 6-11. Look at the self-study problem 6-4. Judy graduates from high school. In the fall, she enrolls for 12 units at Big State. That's at least that's full time, so she qualifies during this term. Her parents pay her tuition and fees of $1,900, and they have AGIs of $78,000. You can look back and see that doesn't qualify for the phase-out range. We're assuming they're married filing joint. It does say that they're married filing joint, so they're not even close to the phase-out range. So the credit should be 100% of the first $2,000, and so her credit should be $1,900. I want to mention the refundability of it. This 40% of the credit could be refundable, which means above and beyond your tax liability. Unlike the earned income credit, which is 100% refundable, you could have a zero tax liability and still get the full earned income credit. In this case, up to 40% of the credit is refundable, which means go above and beyond your tax liability. And last but not least, if you pay tuition and fees and books and things like that in, say, 2013 for a school term that begins in the first 3 months of the next year, January, February, March, of course, then you can actually claim those expenses in the year that they were paid, not that they were not in the year that you went to school. So if you have somebody who's got a little money and wants to pay ahead and can get this credit, then we're in good shape. He could go ahead and pay them in December for the next term and be able to take the credit. And I guess the last thing we ought to mention on this credit is that is something that won't affect any of you, I hope, and that is that the American Opportunity Credit, the HOPE credit, is not available for anybody convicted of a federal or state drug felony, and that is the student. If I assume that if the parent is paying for a student, a son or daughter who's a student, if the student is the felon, as I understand it, then the credit is not available. However, the taxpayer could be a felon as long as his student is not, and the credit would work. Never seen that tried, but that's the way I read it anyway. Okay, let's go to the next credit, which is the Lifetime Learning Credit. This credit is not subject to the felony conviction rules, so all you felons out there can get this credit. You can it's 20% of the first $10,000 of tuition and fees. Does not include books, of course. Transportation and housing not included, but tuition and fees. It's also available for bachelor's and professional courses. And undergraduate, graduate, and professional courses at eligible educational institutions. I imagine there's some fly-by-night places that wouldn't qualify, but most places you're going to go would work. And you notice it doesn't say anything about associate's degrees. Associate's degrees are undergraduate, so that would work. A student can be enrolled in one course, doesn't have to be full-time or part-time, and the purpose is to keep people to working forever. The HOPE, or going to school as long as they will, the HOPE credit, the American Opportunity Credit, really is just for the first 4 years after high school and doesn't include graduate school. This includes any kind of professional classes you take, graduate, undergraduate, and professional courses you take for the rest of your life, at least until they run out of money. Look at the example on page 6-9. Scott pays $1,200 to take a course to improve his job skills. His lifetime earning credit for 2013 is 20% of the $1,200, or $240. Okay, $240. If you'll notice, let's go over to the next page and look at the example with a phase out situation. Jason is a single father, AGI of $85,000. If you'll look back, a single father, that's going to be outside the range from 53 to 63. He paid tuition to $2,500 for a master's degree program in fine arts, and et cetera, et cetera. You can look at all the other stuff, read all the information you want, but due to his phase-out range, he won't be able to get the credit. That's just the way it goes. That's the way the cookie crumbles. Okay, look at the self-study problem on 6-11B. Gene pays $5,200 to take a course to improve his job skills. His AGI is $35,000, so we really don't need to know whether he's single or married because he's below the phase-out range for any of them. So he should be able to take 20% of the entire $5,200, which turns out to be $1,040. So his lifetime learning credit would be $1,040. You can get, I believe, one or the other. You can't get both in the same year. Okay, let's look at some of the limitations now for the lifetime learning credit. Oops, went backwards here. Let's second. Went the wrong way. You can claim, like I said, only one of the credits for each student, and you may take the lifetime learning credit for one student and the American Opportunity Credit for another student, just depending on which one helps you the best. Only the person claiming the dependency may claim the credit, not the dependent himself. You can't claim it for sports, games, hobbies, et cetera, unless that's part of a degree program. And you can't claim expenses that are paid for by tax-free scholarships or reimbursed by employers. Look at Brenda on page 6-10. Brenda works part-time, pays part of her college expenses. Her parents pay the rest. She can file her own tax return, but she can't claim this because she's a dependent on her parents' tax returns. However, they can claim a credit for her. Gary, a college student, works part-time, pays part of his college expenses. His parents pay the rest. His parents have a high income and will not be able to claim any educational credit for him. If his parents decided not to claim Gary, then even though he qualifies, Gary could then claim the educational credit, either the lifetime learning or educational opportunity credit, on his own return. But he would have to be his own, filing his own return. He couldn't be claimed as a dependent on someone else's. Okay, and lastly, you don't have to claim the same credit every year. I know that the software will ask you, did you claim the Hope credit last year? Or did you claim the lifetime learning credit last year? It doesn't matter as far as your taxes go. You can claim the lifetime learning credit 1 year for one student, and the next year claim the educational opportunity credit, and just switch about back and forth, however helps you the best. And that's the main thing to cut taxes down. Okay, let's look at one more example here. Dave and Val, they have 2 dependent children, AGI of $72,000. Quickly look over there. That's below the phase out, so we don't have to worry about that for either one of them. They have a son at City College, taking a few credits. Tuition and fees are $4,200. Have a daughter at Tulane, whose tuition and fees are $39,200. What's the best way to take care of this? Now, what we need to do is take whichever credit would work. We give them the most for each student. Sean can't take the American Opportunity Credit. It's not because he's not working. He's not going to school at least half time. So he would probably be best to take the 20% of the $4,200, which would be $840. Corey, she qualifies for the American Opportunity Credit, so I would go ahead and take 100% of the first $2,000 for her, 25% of the next $2,000, so take the $2,500. So their total credits would be $3,340, and that would probably be the best way to take it. Finally, the last credit we're going to have time to look at today is the foreign tax credit. Just like if you work in Virginia and you pay taxes there, and you work in North Carolina and you pay taxes there, each state will allow you a credit for the taxes you pay in the other state. The federal government allows credit for taxes paid, income taxes paid to a foreign country. Usually, as it says here, you see that mostly on dividends and on foreign stock investments. However, I have a friend who works in Brazil part of the year, and so his income that he earns in Brazil is taxed in Brazil, and then he has to again report that in the U.S. and take the foreign tax credit. Form 1116 is the form you use, and it's supposed to allow some relief. And let me just put the word "some" relief from the double taxation. It doesn't allow everything. You take the net foreign income. You look at the example down here at the bottom. The net foreign income divided by total U.S. taxable income, and then you multiply that by the U.S. tax liability before the credit is considered, and that tells you what your credit is. Look at the example here on page 6-11. He has a net income of $20,000 from country K, and that I think that is really talking about some countries you may have a loss, some countries you may have a gain. Since it usually is dividends and other investment income, you could have losses and gains. Net amount, net foreign income. And by the way, you're not going to have to worry about net income on the test. We're going to tell you what that is. Net foreign income in this case is $20,000 from country K, which imposes a 15% income tax. $30,000 from country L, which imposes a 50% income tax. He has taxable income in 2013 from U.S. sources of $80,000 and a tax liability of $35,000 before applying the credit. Country K, 15% of $20,000 is $3,000. Country L, 50% of $30,000 is $15,000. So the total foreign taxes are $18,000. The overall limitation is $50,000, which is the net foreign income. You see $20,000 from country Z and $30,000 from country K. 20,000 from country K and 30,000 from country L. I always get those countries mixed up. Someday I want to go visit country L. Anyhow, net foreign income of $50,000. You're going to divide that by the U.S. taxable income, which is now the 20,000 from country. Sorry about that. 20,000 from country K and the 30,000 from country L, plus the 80,000 earned in the U.S. So you're going to add all those together. Multiply that by 35,000, which is the U.S. tax liability, and the foreign tax credit is $13,462, or the lesser of the foreign taxes paid. In this case, it's $13,462 is the number. Isn't that fun? They're going to pay $18,000 in taxes to foreign countries, but they get $13,462 as an offset against that in the U.S. It's just a fun world. Look at this example. Joe Steele, $200,000 of income from U.S. and $100,000 from employment in Lithuania. He paid $40,000 in Lithuanian taxes. Assume his tax liability in the U.S. is $85,069. What's his foreign tax credit? Try to remember that, what we did a minute ago. We're going to take the net foreign income, which appears to be $100,000. His total U.S. taxable income, which should be $300,000. So $100,000 divided by $300,000 times the U.S. tax liability, which is $85,069. Let's see how that works out. So $100,000 of foreign net income divided by $300,000 total taxable income for the U.S. The U.S. wants to tax your income in other countries, by the way. Multiply it by the U.S. tax liability of $85,069. His credit then is $28,356. You can carry it back 1 year or carry it forward 10 years. He's going to have to pay $11,644. That's what he paid was $40,000 to get to $28,356. So $11,644 that he gets to carry back or carry forward. I just love the IRS. Okay, we're not going to talk about the adoption credit. The adoption credit is pretty complex, so I'd like for you to read, starting on page 6-12, go all the way to 6- go to 6-19 or the bottom of 6-18, where it talks about the individual alternative minimum tax, and we'll go over that a little bit, but we're not going to go spend a lot of time on that one, like I said before. And then, if you will, look on page 6-22 and following that, the unearned income for minor children and students. And we'll talk about that on Monday. Y'all have a great Easter, and we'll talk to you later.